You're entering the future-ready CNBC TV18 EBIX Cash Studio.
Good morning and welcome to Bazaar morning call from the CNBC TV18 EBIX Cash Studio. I am Anuj Singhal and with me Prashant and Sonia, and of course we had a weekly holiday yesterday and midweek holiday rather yesterday, and we've come back with some.
Hope it is a weekly one, Anuj.
I hope. Most would hope that it was a weekly holiday. Yeah, that we were not trading today. It would have been perfect scenario, but in reality you have to face the tough situation, and that's what you faced this morning. The global markets completely spooked at the moment. I mean, just look at some of the markets. Of course, now that's everyone's, to everyone's knowledge that markets are down 2% to 3%. What next? Is this going to be 2004 moment? I just want to point that out because Prashant would remember that 2004 was a year when the Fed raised rates and the markets had a massive rally. But of course, we'll deal with that later. For now, the SGX Nifty is indicating that we will have 400-point decline for starters. Good morning.
Hi, good morning, Anuj. Good morning, Prashant. So it could be a tough day or it could be an opportunity, right? Whichever way you look at it. As you said, I mean, in the past, it's happened that the market has rallied in a big way when central banks globally started hiking rates. But there's been large selling from FI, so no two ways about that. Got to put the numbers for you on the screen. 7,000 crores was sold on the 25th, and put together about 26,500 crores sold in January so far. Not a small amount at all. So the big headline is that central banks will be raising rates from March. Now, there are two questions on my mind, and either of you are free to sort of put your views on board. Anuj, is it in the price? A, it doesn't look like it, at least as per what the SGX is suggesting. And B, the event risk is largely out of the way, right? I mean, we know now what the Fed has said. So is this a good buying opportunity?
On that, the question, the bigger question is that the rally that we had, was it purely liquidity-driven rally? Or was it a rally which is really backed by fundamentals? I think there were large part of markets which were purely driven by the liquidity, and some part of the market which has been driven especially by fundamentals. So I think you'll have to make the differentiation now, that part in which you could just come and buy any stock every morning and make money, that will come to an end. But I tell you what, you will make a lot of money in this phase if you get it right, of course. For starters, we'll talk about today's trade because SGX Nifty is indicating a 300-point gap down. In fact, make it 400 points now. There's FNO expiry today, Sonia, so moves can be wild on both sides. On Tuesday, market at some point will become oversold. And today's expiry, so that's what you got to watch out for. The levels to watch, I think levels become very important in a market like this. 16,836, which is the Tuesday low, is the first level to watch, and 200-day moving average of 16,615 is the all-important levels. Now, the bull market corrections can be brutal. 10 to 20% is normal. In fact, in 2004 to 8, the biggest bull market that we had 3 instances of over 20% correction as well, and one correction of even 30%. So I'm not saying that we'll go there, but even at today's low, we would be 10% off the highest point, just to put things in perspective. The Bank Nifty, that's rallied 3.5% from Tuesday low, but 36,400 to 36,800 is that important zone for the Bank Nifty. 36,400 is Tuesday low, and 36,800 is the 50-day moving average on the Bank Nifty. Like you pointed out, $1 billion selling nearly in a single day, and in January about $3 billion. That's creating a bit of a fear factor. But my sense is that this money may come back if, and that's a big if the budget is good and the market is light, and it just doesn't happen that everything goes down in one way. So February, perhaps we might be preparing ourselves for a big run. Post-budget rally is possible because the market's going into the event pretty light. But Prashant, good morning. Did you get sleep, or were you watching Powell?
To be honest, I was going to tell. I stayed up till about 12:30. 12:30 our time is when the decision came, and I checked and I said, well, it's normal. It's dovish. No, it was dovish because there was a statement which was out and it was absolutely in line. There was nothing else, and I woke up and then I went to sleep, and then I woke up in the morning and said all hawkish. So it was actually exactly deja vu. Not the Fed action, but the market action day before yesterday, if you remember.
So the bottom line is, you don't need to stay up that late. When you wake up in the morning, anyway, things are different.
The smart ones, I mean, there's nothing you can do about it, right? So you just got to deal with it when you come back in the morning. Okay, so the Fed's, the FOMC has been hawkish, absolutely no doubt about it. Make no mistake. The statement was in line, as I said, but the press conference is essentially the most hawkish it's ever been under Mr. Powell, the Fed chair. So what happened? The statement signaled a first rate hike is coming in March. This was as expected. But two or three things as far as the press conference is concerned. Powell was asked in the press conference whether the pace of rate increases is going to be the assumed 25 basis points in every meeting, or it could be faster. There was no pushback. Actually, Mr. Powell compared the 2015 moment when rates started moving up, but he said labor markets are much tighter, inflation is too high, and generally, I mean, this is a very different hiking cycle. It's likely to be a very different hiking cycle. So not only is the pace perhaps going to be faster, but even a 50 basis point in one of the meetings is not ruled out. Will it be March? We don't know, but he's not pushed back against it. He did not kill that idea completely. The other point is some were thinking, well, markets have corrected quite a bit. You know, the Fed will maybe scare a little bit, but absolutely nothing. He indeed pointed out that it's to be expected that financial conditions tighten when the Fed pivots from a very loose monetary policy to becoming a little more tighter. So he kind of acknowledged and owned the correction in the markets without really saying that I'm worried. He actually at one point in time said that financial conditions still remain extremely loose, right? So no pushback to that either. And that's why I'm saying all in all, I mean, this was a hawkish kind of policy. The signal from markets, and this is interesting again, I'll keep it very brief. The S&P and the NASDAQ, almost a repeat of what we saw, the last trading session, the day before our last trading session in the US. So 3% off from the highs on the S&P, 2.5% off the highs on the NASDAQ. You had the market pricing for Fed hikes, which moved up 30 basis points in March, 112 basis points for 2022. Yields across 2-year, 5-year, 10, 30, everything moved up. The dollar was strong. Oil prices are almost back at about $90 a barrel or so. Just one thing though, and we can get into details later, a lot has been thrown. I'm talking about the US market now. A lot has been thrown at the US market over the last 3 days. But the fact is, there was one intraday breach of the 4,300 level of the S&P, which is technically important, but it has not broken yet. So I think, you know, there has been a fair bit which has already happened. And the point is, markets respond to the fear of something happening. We now know what the Fed is thinking in absolutely unambiguous terms. So will there be, you know, more severe, large down days? Maybe it kind of, we see more volatility, perhaps sideways kind of market. But the fact is the cat is out of the bag. And I think we know now in no uncertain terms that this is what the Fed wants to do. There should be no confusion about that now, because markets were expecting that, well, they're saying it, they're signaling all of this, but it's not really going to happen. Well, it is, according to the Fed.
So the event risk is perhaps largely out of the way.
Absolutely.
The only problem in this is that it's quite a lethal cocktail of higher Brent prices, higher inflation, perhaps slower growth because of COVID, and now hiking in rates, right? So, as I say, when it rains, it pours. So perhaps that's what the street is.
You know, Sonia, just one thing which Anuj was also pointing out, that 2004, right? Just one important difference is that in 2004, the Nifty P multiple was 12 times, right? We were starting absolutely at the low. It's 22 times now, right? So
no room for
expansion, right? When you say that central banks are hiking and can equities do well, well, they have in the past, but the starting point matters, and the starting point is very high, unfortunately, now.
But the starting point of the rally was 2003, Prashant. The rally started in 2003. So similarly, the starting point for this rally was also last year. So let's see, and you know what, the multiples worldwide have adjusted. So let's see. But I mean, of course, you know, the market not necessarily move in the same way every time.
History doesn't repeat itself.
History doesn't repeat every time, but in stock markets, history is a fairly good guide. You know, fairly good guide, and that's why.
Let's hope it rhymes.
Absolutely, because you know, at the end of the day, stock market is about greed and fear, and those are two emotions which haven't changed for 100 years and won't for next 100 years. So that's why, you know, that's why we give so much importance also to the technicals, right? The 200-day moving average, you know, because you know these matter. You know, there's a reason why they work every time.
Okay, so if you're greedy, right, which a lot of people are, there are a lot of companies that are reporting good numbers. So we thought we'll just put them on board very quickly. Maruti's commentary was very strong at the conference call day before yesterday. They said that demand is picked up, inquiries have picked up as well, and a lot of brokerages have raised their earnings estimates on Maruti. So keep that in mind. Cipla reported a very strong numbers, more on that in a bit, but the India business has seen a double-digit growth yet again, so the street could like that. Teamlease had a good set of numbers as well. It was the highest quarterly addition in general staffing, so I'll watch for that. And finally, Macrotech developers. We all know that there's a big boom currently in the real estate space, and Macrotech has showcased that in their numbers. The only niggling worry is on this higher Brent crude prices. I mean, $90 a barrel. So definitely negative for aviation companies, tire companies, paint companies, etc. But we'll track all of this and more for you in the next 2.5 hours. It's an action-packed day, so do stay tuned in to our channel. On the equities front, first up, we have some opinion coming through from Surendra Goyal of Citi, who says that a potential announcements that could positively impact markets in the near term are tax changes paving the way for global bond index inclusion and clarity on asset monetization and divestment timelines. Citi economists expect no major tax changes this time. Looking ahead, investors need to watch for the upcoming state elections, RBI stance and global cues. Market is factoring in continued strong earnings momentum and absolute relative valuations are elevated. Citi's December 2022 Nifty target is 17,500.
Let's get you some money market views then. Kunal Sudhani of Shinhan Bank says the dollar soared on a hawkish bet as stocks plunged and yields jumped. Fears emanating from the Ukraine-Russia virus wars and Sino-American tensions and rising Brent prices also contributed to dollar bullishness. For the dollar INR, 74.80 acts as support, while 75.30 is resistance, referring to the Chinese tension, of course.
All right, and on the bonds, Dhaval Dalal of Edelweiss says the FOMC's hawkish comments and guidance are in line with the market expectations. That probably means range-bound treasury yields for some time. Back home, the focus will shift to the union budget and demand-supply dynamics as gross borrowings of $21 trillion between centre and states in absence of the RBI is going to have an impact on sentiment. He expects the 10-year bond yield to trade in a range of 6.65 to 6.75% in the near term amidst weak sentiment.
Okay, like we told you, the big global story is the US Fed meeting. First up, let's hear out from the man himself, Fed Chairman Jerome Powell. I saw a headline saying, well, not Mr. Nice anymore. And I think for markets, that kind of describes it. Let's listen in.
The economy no longer needs sustained high levels of monetary policy support. That is why we are phasing out our asset purchases and why we expect it will soon be appropriate to raise the target range for the federal funds rate.
Okay, and that statement, of course, led